Hello, welcome to your favorite Shridevi Classes YouTube channel where we inculcate interest in science, engineering, and management subjects. Today, in our playlist of project management and entrepreneurship, we'll discuss the role of cash and credit in business financing. We'll first explain the money term cash and money in credit, and then we'll discuss their role in business financing, and we'll also understand the interplay of these two type of money in business financing to manage all money related financial matter of business. So let's start. Let us understand the term cash in business. Cash is a physical form of money, and in fact it is the simplest, most broadly accepted and most reliable form of payment. Cash or currency is legal tender that can be used to exchange all sort of goods, services, can be given to clear debt. Now cash also include all that money which is in your bank account and can be used in e-payments. One can also treat all marketable securities such as share, government bonds, bank demand drafts, and monetary value of any asset that can be quickly turned into physical cash. Nowadays, due to increasing dependency and convenience of electronic banking system and e-payments, cash is becoming less common, and in place of cash, we are using electronic banking and internet-based payment systems. What is credit in business? So, credit is a contractual agreement in which borrower receive something of value immediately and agrees to pay for the same, sometimes with even interest later on, and that understanding between two parties is credit in business. So credit allows consumer to purchase just about any material or services on credit. Some financial institutes and banks issue credit cards, and such credit cards can become an intermediary between buyer and seller. And when a buyer purchase any item from seller, the bank through credit card pay the seller in full while extending the credit to the buyer, who may repay the debt to bank which issued credit card over some decided time, including interest charges calculated until it is fully paid off. So bank and financial institute also play important role in business financing through credit card facilities. Cash and credit are two fundamental components used in business financing that play pivotal key role in operation and activities of business. While cash provide liquidity and facility for immediate purchasing power for any goods or services, whereas credit extends the same capability to make purchases and investment beyond immediate financial means. The understanding of interplay between cash financing and credit financing is very important for any business to effectively manage their operations, all investment, and to ensure financial stability and sustainability. Let's understand the role of cash in any business. The first important part which cash play in business is liquidity or flexibility. Cash is a lifeblood for any business. It provides liquidity for all day-to-day affairs, and all business activities which need money can be managed by available cash. In financial terms, liquidity is ready cash which is available to pay all short-term obligations or liabilities that include payments for all supplies of goods and services, payment to employees, salary and wages, and other expenses which are there in day-to-day activity of business. And all assets which are called liquid assets can easily be converted into ready cash without affecting the market price of that asset. So liquid cash and physical cash both provide liquidity, flexibility, and ease to manage day-to-day affair of business. Another role of cash in business operation is working capital management. When we pay all current liabilities from current assets, the remaining money available is called as working capital, and this working capital can be utilized to pay bills of all supplies of goods and services or for payment of labor bills, and it is also utilized to invest in those financial sectors that can spur, boost, increase business growth. When we have net positive working capital, that means current assets are more than current liabilities, then this is good practice which maintain adequate cash reserves that ensure smooth, the most productive and efficient functioning of business operations, that enable business organization for timely payments, and that also mitigate any probable risk of financial failure. Thoughtful, visionary business organization also maintain a emergency fund with available cash, and this is a small cash reserve that serves as a buffer which is used during some unforeseen circumstances such as economic downturns, natural disasters, or unforeseen accident in business operation, or other unexpected expenses that may occur. And this money which is set aside for such unexpected expenses, emergency fund, ensure business continuity also in most adverse and odd conditions. Cash reserve or positive working capital also provide investment opportunities to business organization. Availability of cash reserve offer the flexibility to capitalize the strategic investment opportunities, and this investment can be used to acquire valuable physical assets, expanding operations, or even to pursue research, development, or innovation idea in business organization. In large businesses, credit got more strategic role in business financing than cash, and one business activity is expansion and growth. The credit allow businessmen to access additional fund from banking organization or trade credit from supplier, and that can be used to expand the business by opening new locations, diversifying product lines, or entering new markets without relying solely on internal cash reserves, which are very limited most of the time by retained earning. So when a business need access to additional funds, it can avail credit facilities for expansion and growth of business. Cash in business got limited volume, and for managing cash flow in business, we often use credit in our business, and utilizing credit facilities of banking and financial institutes by term loans or line of credit, or utilizing trade credit where buyer business obtain goods and services from supplier without paying the money directly on that time, but as per terms due payment can be made later on as per negotiation made for trade credit between seller and buyer. And such credits helps in managing cash flow fluctuations and provide access to funds when needed, and that allow business to maintain smoothness in its business operations. Physical assets of business need good amount of money, and that may not be available by cash positions. So credit is required to make investment in assets, and when one business need acquisition of long-term assets such as machinery, essential equipments which are quite costly, or even some real estate investment need money, and credit enable businesses to enhance productivity, competitiveness, and profitability. So when large amount of money is required for investment in assets, one can go for credit financing. A business of good credit ranking, which have repaid all its debt with interest, can use credit financing to build its business relationship, and such business organization use credit to strengthen their relationship with suppliers, vendor by money from banking institutes, and they also strengthen their relation with financial institutes by a regular repayment of fundamental amount along with interest, and this leads to favorable terms and condition from both supplier vendor as well as financial institutes. When our business need money, they can also got discount from supplier and vendor, and discount in interest rate from financial institute, and good business relations, higher credit ranking, improve access of business to future financial needs. Cash or liquidity in business got a limited amount, and when we diversify from cash to credit source of funding through various credit instruments, it will mitigate our risk which is associated with over reliance on internal cash reserves. And this intermixing of credit financing along with cash provide a cushion to our business operations against all sort of economic uncertainties. So cash and credit in business are complementary aspects of financing. Each serve distinct yet interconnected purposes. So both are important in business financing, as cash provide immediate liquidity and financial stability, but it got limited volume, and credit many a times unlimited in amount offers opportunities for growth, investment, and flexibility in managing financial resources. But to maintain good credit rating, by effectively managing both cash and credit, business can optimize their financial operations, can grab all growth opportunities which are available in front, and can also tackle all challenges which are in face with business. Cash, present available money, and credit, future money, both are essential but distinct financial resources in any business operation. Cash provides liquidity and solution for concern of immediate attention, while credit offer additional financial resources for investment as well as expansions. The interplay, combined use of cash and credit in business can be managed for several ways, and we'll discuss those one by one. A company can use cash for investment and expansions, but often cash got limited capabilities and remain insufficient. So credit can provide additional funds which are required for investment and expansions. Say for example, a company may use cash for developing new products, but for working capital and developing new markets, company may rely on credits. So projects which can be handled by small amount of money without burden of debt or interest can be managed by cash amount, but for larger amount of funding we may need support of credit funding. Both cash and credit are used to manage cash flow. The availability of cash at the right time manage majority of cash flow problems, but many a times when cash is insufficient, credit facilities can assist in managing cash flow gaps, and the two together, cash and credit, ensure smooth functioning of business operation. The operational financial policies of any company or business are very important to maintain sustainability and financial health of any business operation, and for that we have to balance both cash money and credit facility in company financial affair. And before obtaining additional credit for any business operation, a company should thoroughly assess its financial situation so that it can manage all risk which are associated with debt and interest payment. So to manage the risk of over leverage, company should restrict amount of credit funding in its business operation, and if financial situation is manageable, company can expand its business through credit funding. Interplay of cash and credit is also used to develop good financial relationship of business with stakeholders. The right balance between cash amount and credit funding is used to develop strong financial relationship, and this management enable the company to access more financial resources for its business operation. So we can say interplay, mixing between cash amount and credit financing form a synergy that strengthen companies' financial and fiscal position and add smooth management of all affairs and operations, and with a proper balance between cash and credit. Using both financial resources, management can contribute to the success and sustainable operation of the business that increase efficiency, effectiveness, and profitability. We hope this beautiful learning video has explained the role of cash money and credit funding in business financing. Our other learning videos of the same playlist are equally useful, and you can use them in your study or refer the same to your friends. And if you need study support material from this channel, do join our membership. Happy learning. Have nice time. Thank you very much.